Happy and healthy New Year's from ADK Wealth Advisory Group. Today we're located in the tundra of St. Louis. We've been experiencing snow and heavy cold, so for our clients down in Texas, we're wishing we were with you. In any case, our purpose today is really twofold. Recap 2013, look forward to the first half of 2014, and I'm joined by Rich Kurowski, Certified Financial Planner, where he'll cover our thoughts around energy for the day. When I think of 2013, a central theme would be the grand experiment of central banks throughout the world. What I mean by that is, if you go back to 2008, where we had a major collapse of the financial industry as well as the financial markets, the central banks intervened with stimulus policy that was very much necessary. But if you liken it to other periods going back to, say, the Depression or even periods before that, what the central bank did this time was so much more and so much more involved that's why I call it a grand experiment. So if you think of it in terms of a chess metaphor, in the game of chess you have early game, mid game, and late game. So the United States Federal Reserve, led by Bernanke, the central issue was around what we classify as asset repurchasing, where the central bank prints money and then uses that printed money to purchase the debt of the government. Somewhat of a shell game, but the net effect of it is that it's a very stimulating oriented monetary policy. So some things that occurred this calendar year: Bernanke believes that you should provide guidance to the financial markets. In the summer, when he did that, letting the markets know that there would be a reduction, a tapering, if you will, in the future, the markets absolutely freaked out over that. Interest rates went up, the stock market dropped. You would have thought that he had already done something, but it was just purely in anticipation of that. However, if you fast forward time into December, when they actually announced $10 billion of tapering, so the $85 billion a month down to $75 billion a month, the markets responded jubilantly, where the equity markets were up a lot that day. If you think that that metaphor we were using earlier, now that they're starting to taper in the United States, the chess game really there is late game. Some other issues that were very significant around the Fed were in the area of Bernanke's tenure coming to closure and Vice Chairwoman Yellen being nominated, and now the Senate has approved her to be the next chairperson of the central bank, which will be the first time in the United States history that a woman has been the chairperson, which is quite interesting. The other thing that I would say was kind of interesting was around in the United States was the U.S. debt ceiling. There was an enormous amount of media concern and really a political game of chicken that went on that freaked out world markets for a while. In the end, compromises were made. Some more still need to be made, but it appears as though the fiscal policy war that's been going on in Congress isn't as upsetting as people were concerned it would be to the financial markets. If you go across the pond to Europe, you could see that the Bank of England is doing a very similar type of asset repurchase. Much smaller in size, but still significant. If you look throughout the rest of Europe, the European Central Bank has not actually done any asset repurchase, but mentioned that it would if needed, and that it would do whatever it takes to keep the euro intact. And that mere policy promise caused interest rates in the southern European PIG countries that were having problems to really drop a lot, which got the desired result. If you go to Japan, while Japan's economy is not nearly as large as the United States, when you take a look at the amount of asset repurchase they're doing in nominal terms, it's significantly larger compared to their GDP than what the United States is doing. And as a result, the Japanese financial markets have done extraordinarily well. If you shift gears, but you stay in the central theme of central banks and you go into the emerging world, if you take a look at China, for example, China's issues are very different. They don't have the debt problems. What they have more of is issues of how do we continue to grow the economy, put a lot of the peasant farmers into more of an industrialized worker environment, but yet control inflation. So as a result, their policies have been more tightening. And as a result of that, you can see disappointments around the economy in China. And you could shift gears and go to, say, India, where their central bank has had a lot more difficulty. In our last market update for the third quarter of 2013, we talked about capital market rotations. And India was probably the most affected by a capital market rotation this past year, where their central bank was trying to stabilize their currency, but because of interpretation of what the Fed was going to do, there was a lot of money exiting India and coming to the United States, which caused the Indian rupee to drop a lot, which creates more inflation when they're trying to purchase stuff. So kind of interesting when you think about the developed world versus emerging markets experiencing different things, but the central banks are very involved. When you go to what I think of as real emerging markets now, places like Turkey, Indonesia, that's where the central banks really are so small that they don't have the ability to have monetary policy that's strong enough to affect other countries and other regions' monetary policy affecting them. So it's been fascinating to watch the problems in the true smaller emerging markets. When I transfer from economies to financial markets, pretty fascinating in that the United States led the charge when you take a look at how the equity markets did. A distant second would be developed world international stocks, and then a distant third would be domestic high yield bonds. All three categories did very well. If you take a look at the areas that disappointed the most, without a doubt gold would be the largest disappointment. I think most people are surprised in the backdrop of how people perceive how difficult times still are, that the safe harbor assets dropped and plummeted, and no one really knows, has the bottom been hit or is it going to continue to drop? Some other areas of disappointment financial market wise would be emerging market bonds, also referred to as emerging market debt, and municipal bonds domestically, surprisingly enough, but with some of the concerns that sort of flooded the market as a result of Detroit's bankruptcy, concerns around Puerto Rico, and then just some major states like Illinois, California having systemic problems with pensions and whatnot. Some categories that necessarily didn't disappoint but certainly didn't do anything positive, so we'll just call them as neutral, would be short-term bonds domestically, as well as things like publicly traded real estate. An area that probably surprised people the most, because it really wasn't an asset class people knew much about, which is this all market or tactical, basically industry analysts and portfolio managers that do trend following. That was an area that surprisingly did very negative as well. As I transition from central banks to different countries and their economies, you could summarize it by saying that even with the amount of stimulus that's coming from central banks, the economies across the world are all growing at lower levels than what one would hope. For example, the United States has consistently underperformed compared to what the Federal Reserve was projecting. That said, it's still growing at a positive number, call it around 2%, which when you take a look historically, that's not a bad rate to grow at, especially when you take a look at the size of the sheer size of the economy itself. When you then take a look at Europe, you could say that much of Europe is in a recession. Not all. The northern European countries are doing better than the southern European countries. Inside of the southern European countries, though, you really have some areas that have depression-like settings when it comes to unemployment. Spain is a great example of that. When you shift gears and you go to, say, Japan, Japan's in a unique situation in that the monetary policy there really is providing some great stimulus. They're having the best economic performance that they've experienced in decades. That said, it's still under what the United States is growing at. And then when you look at the emerging world, China is without a doubt the second largest economy in the world and doing quite well It's experiencing mid to middle single-digit returns on its GDP, but that still disappoints compared to what they were expecting. You look at India, India has some problems of its own, but the real problems lie in what I'll classify are the small emerging markets, places like Bangladesh, Indonesia, and Turkey. Those countries are so small in their economy that they're fragile when it comes to capital market rotations, that they're having a difficult time absorbing. So if I were going to summarize 2013, I would summarize it by saying that a grand experiment's been going on. Central banks have been adding monetary policy that's been very stimulant, and the net effect of that has been risky assets have done very well. The other effect of it is that interest rates have begun to rise, and investments that are negatively affected by rising interest rates have been hurt. At this point, I'd like to transfer over to Rich to talk a little bit about energy.
In the last several videos, we've discussed the U.S. and North American energy boom. We've talked about the primary reasons for that boom. First is the availability of shale gas and oil throughout the United States, and second is the development of new exploration technology, specifically fracking and horizontal drilling. Now, the U.S. is positioned better than any country in the world to take advantage of this boom, since we have 60% of the available drilling rigs around the world, and 95% of those are capable of horizontal drilling. So as a result, we're seeing today the U.S. is the largest producer of natural gas around the world. Some of the benefits of this include the fact that greenhouse gas emissions today are at the lowest levels they've been since the early 1990s. And this is primarily due to the fact that natural gas is being used in place of other sources of energy for power production here in the U.S. Millions of jobs are being created, both direct jobs in the energy industry and also indirect jobs in other manufacturing industries. And there is definitely a manufacturing resurgence going on in the U.S. We continue to see examples of companies moving to the United States, moving their production facilities to the United States from other countries. And in every case, the reason given for this is the cheap, plentiful, and reliable energy sources here in the United States. And just today, the Wall Street Journal reported that primarily due to the booming energy sector, the U.S. trade deficit is at its lowest point since 2009. As a result of this, estimates for growth for 2014 are increasing. Now, there's several issues involved with the new technologies, and we'll talk about three of those, specifically those around water. First is water consumption, and specifically we're talking about the amount of water that's being used, and also the equitable allocation of that water amongst all the different users. Second is protection of groundwater, and this can mainly be addressed through better well production and providing protections in wells for the groundwater around them. And third is the safe disposal of wastewater. The Department of Energy, several companies involved in production, and also universities are involved in developing and researching and developing new ways of recycling wastewater and also filtering wastewater. So progress is being made. The last issue is the issue of methane emissions. Methane emissions, specifically methane emissions around the well sites. Methane as a greenhouse gas is 25 times more potent than carbon dioxide. So again, this is an important issue. Research is being done and progress is being made too in collecting this methane at the well site. For all these issues, there's conflicting information available, so I want to just refer you to several excellent websites that have information regarding these issues, and also the energy production industry in general. Those are, first of all, EIA.gov, which is the Energy Information Administration website. There's also an excellent website called fracfocus.org, which is sponsored by several environmental groups and also energy production groups. Again, they have information about energy production in general, and specifically about the technologies that are being used. So informed discussion and debate will hopefully lead us to take the correct course of action in addressing each of these issues. One thing for certain, here in the U.S., we have a once-in-a-generation opportunity to take control of our economic and our energy destiny.
Rich, thanks for the update on energy. I have to say, if I were going to pick the most exciting part of what we're talking about, it really is that energy renaissance that's going on in North America. If you liken it to history, you'd have to go back to the robber baron period to be able to see the dynamics of what kind of an effect energy is having on a given economy. As I shift gears and think about 2014, and we talk about the theme of chess and early game, mid game, late game, the United States, I think the biggest challenge for it is because the central bank's going to be tapering. Is the U.S. economy stable enough to be able to handle what I'll classify as less stimulus? There's still going to be a favorable monetary policy. It's not going to be constraining, but is the economy really stable enough to handle that? I think that the answer is yes, but it's not going to have enough strength, in my view, to handle any major shocks, some type of a global collapse in the financial markets, say starting in Europe or something like that. I think the probability of that is low, so I think the first half of the year is very solid. I focus on first half of the year, which is kind of interesting because when I used to do these kind of market updates, I would think in terms of a year to 3 years, but with the way that things move in today's world and how fragile things are, really I'm thinking in terms of a quarter or 2 quarters at a time. So we're really talking about the first 6 months of 14. If you take a look at Europe, I think that many parts of Europe start to recover next year. But the parts that are in that southern Europe, I would say that they're hurt enough where they'll just continue to decline, but at a slower pace. I don't think that those pig countries have seen the worst of what they're going through yet. But that doesn't mean all of Europe when I make that comment. And then when I look at Japan, Japan's pretty exciting in that when I think in terms of their central bank is still in early stage of their chess game. So they're still providing an enormous amount of stimulus, which is really helping fight their deflation and create inflation. Everything that they're doing so far is doing what it needs to do. And so I think that's very exciting for Japan. China, when I think in terms of China, I think that they are the main source of growth economically throughout the world. I think that continues, but I think that the rate of their growth, because they're now the second largest economy in the world, is going to continue to displease financial markets who are wanting them to grow at 8 to 12%. I just don't think an economy that size is going to have sustainability to be able to grow at that level. The real risk, as I see it, is when you go to the small emerging markets, Turkey, Bangladesh, Indonesia. I think they'll have continued problems because there's strikes where you'll see labor unions forming, fighting for higher wages, and they don't really have the stability to be able to handle that because on a dime, an institution can move from Bangladesh and go to Vietnam. And even though you're talking about small incremental price increases, they can go and get cheaper labor somewhere else. So I think you're going to have a lot of problems in those lower tier emerging markets as they struggle to find their own way. That coupled with issues of money leaving those countries and coming back to the United States because of tightening monetary policy. In all, I think you could summarize 2014, that first half, and you could say that it's a continuation of what's happened in the third and fourth quarter of 2013. When I transform that into asset classes, I would have to say that I think the riskier assets continue to do well. One asset class that did really poorly last year, that's hard to really define what's going to happen this year, is gold. And when I take a look at gold, it's one of those areas that it's plummeted. My personal opinion is that it probably has hit the bottom, but there's a lot of forces that leave that unknown. So in conclusion, I would like to say thank you very much for choosing ADK Wealth Advisory Group to help you pursue your life dreams and financial goals. I'd also ask you if you would forward this video along to people that you care about. And a best way to do that, if they'd like to be able to be added in the future to this, is to like us on Facebook or connect with us on LinkedIn. On that, we'll bid you farewell to the end of quarter one. Thank you.